Hello and welcome to another episode of the Express Economist. Today we have with us Professor Sudipto Mundle. He is the chairman for Center for Development Studies, and we are here to talk about India's GDP data. As many of you know, the Ministry for Statistics and Program Implementation has just released the provisional estimates for national income, both GDP and GVA, for the financial year 2020, that is the financial year that just ended in March. And this was a crucial data because it told us how India recovered from the shock that we had in financial year 2021 due to the COVID pandemic. So to discuss more about India's GDP and what he makes of it, what is the strength of our recovery and what are the challenges ahead, I welcome Professor Mundle. Thank you, sir, for joining us on the Express Economist.
Yeah, thank you.
I would like to first ask you a very basic question just to get a sense of what you made of the GDP and GVA numbers. And then maybe we can get into some specifics about the subcomponents of where the growth is coming from or where it's sort of getting dragged. What are your initial comments on the data?
Yeah, first of all, the last normal year that we had was 1920, as you know. And then 2021, we got the terrible shock. And as a result, the subsequent year, after the GDP went down by something like 24% in Q1 of 2021. So you got a big bump up. So these base effects were having very strong effect, both downwards and upwards. So it was a very distorted picture. I hope we are now finally seeing the end of this, because even last year, if you recall, it was the Delta, that was the second big wave, and the Delta version hit us. And so in Q1 of the year that is just over, again, we had got a shock. So Q1 of this year, I'm talking about 22, 23 now, will also have a base effect. But by and large, other than that, I think we are getting out of it. Now, that being said, we had actually, we use a high frequency data-based forecasting model, and we had actually forecast a growth of 9.3%. We're actually about 0.5% below that. So I have a feeling our model may be having some little bit of a upward bias. That being the case, we are now actually projecting a growth of 7.5% based on this model for fiscal 22-23. Now, making allowance for this little upward, bias, maybe we'll grow at around 7%. It depends very much on what happens to the whole Ukraine war scenario, how long that will continue. It depends on how quickly China can recover from this recent shock they had of the 100% lockdown because of COVID there. So maybe we'll even go a little below 7%. But so it's in that range, 7% plus minus 0.5% is where I would put my finger. This is for the new financial year.
So we'll come to the question about, where the growth may be in the current financial year that we are in and perhaps in the year after. But let me ask you a broader question. One of the things that worried all of us was that since 2017, the start of 2017, as it were, the financial year, India's growth momentum was steadily getting lost. We were sort of every year we have lost growth momentum before we came to the COVID shock. And in 2019-20, which was just the year before, which is the last normal year, as it were, we grew at just about 2.8%, and which is quite a low growth rate for an economy like India. So, so the question in my mind was that if the economy was struggling to grow or losing its momentum going into the COVID pandemic, has it regained the momentum coming out of the COVID pandemic? So how do you sort of see that?
Yeah, it's the picture is very mixed because you're quite right. It was a secular downward movement in the growth rate anyway before the pandemic hit us. Then that got compounded by this massive, unprecedented shock during 2021. But then you also got the policy response to it. Contrary to what a lot of commentators would say, actually in 2021, even fiscal policy was very expansionary. There's a very substantial increase in, they actually didn't, the revenue went down, but they didn't allow the expenditure to go down. As a result, the deficit went up very substantially. And of course, on the monetary policy side, the RBI again took a number of unprecedented steps to push liquidity. And I think they were very successful in that. So it seems to me that these attempts to have quantitative easing have proved very effective and may actually not only sort of helped us put us on a recovery path relative to the big shock, but may even put us on a growth path, which is recovery of the earlier slowdown that you were referring to. It seems to me, because if we, of course, this year we've, grown at 8.7%. If we also grow next year at somewhere around 7% plus minus, half percent this way, that way, that begins to look like we are getting onto a better growth path compared to where we were even before the pandemic.
Okay. Now, specific to the GDP data that we saw, GDP and GVA. So I'll first ask you about the subcomponents of GDP. One big concern that everybody is pointing to, and the data is there for that, is that the biggest engine for GDP growth in India, which is the private final consumption expenditure, the money that you and I spend in our personal capacities, that growth is very weak, very anemic. I was looking at I was comparing it to the fourth quarter of 2019-20, which was the last, pre-COVID. And private final consumption expenditure had grown by just 1.7%. And in this quarter, the last fourth quarter data, it has grown by 1.8%. So it's very similar in terms of, now obviously the Omicron effect and everything might be there, but how concerned are you about the overall health of the private final consumption expenditure?
Yeah, that you quite correctly point that remains really the one of the major weak spots. I'll come to the other one later, and I think it'll take some time, for this recovery to sustain itself. I think we have now gone past, I'm talking the absolute level of GDP that we had at the end of 1920. We are now gone past that. And I think if we really grow at around 7% plus minus during the current financial year, we are doing well, and eventually the consumption is going to recover. There's economists nowadays, based on models developed for the Western economies, expenditure is something autonomous. That's an independent driver. But certainly in our kind of economy, it is largely based on income. So it's consumption is a residual, a sort of derived effect of changes in income. And, unlike in advanced countries where consumption, a lot of it really comes out of the wealth, stock and all that. So it's less sensitive to income. In our case, we are very sensitive to income. So the slow, the poor performance of consumption is really a reflection of the slow growth that we've been going through. And if growth recovers, I expect consumption to recover. But there are three other engines of growth which are genuinely autonomous and leading. one is government expenditure. Second is the investment expenditure. And the third is the net exports. And I am underlining the word net. That is export minus imports. Now, of these three, the government expenditure this year is likely to be a bit constrained because they've just cut the fuel taxes and so on. And even this morning, I think the finance secretary was reported to be saying that they will take a hit on the revenue side, tax revenue side, but they will try and meet that with cuts in revenue or current expenditure rather than capital expenditure. Now, if they can manage to do that, that is very good, but it's easier said than done because a lot of revenue expenditures really are what we call committed expenditures. Wages and salaries and interest payments on past debt. You can't do much with those. You can cut a little bit of the discretionary spending on things like subsidies and so on, or things like Manrega, which actually I hope they will not do because these are really relief expenditure, which is very important in a poor economy like ours. So there are risks on the fiscal side. The monetary policy side, of course, they have been now trying to rein in the loose monetary policy we've been following. As a result, interest rates and so on will gradually go up. The question is, how is all this going to affect the second independent component, namely investment, in particular the private investment cycle? If the government can maintain its expenditure, because this government is very focused on infrastructure and so on, as you know, so I think they will work very hard to try and not cut back on that. But the large bulk of investment is the private sector, and the question is, how will all this affect private sector investment plans and so on? It's good to see that while the portfolio investment money has been going out, the FDI foreign money that's come into the more stable, the desirable kind of investment has actually been doing quite well. And I think our private investment cycle is also beginning to recover. Because if you look at the ratio of investment to GDP in the last few, in recent years, last couple of quarters and so on, it's not as high as the peaks. We had gone up to 37, 38% earlier. But it's not bad now. It's, it's around 32, 33%. So that suggests to me that the second engine of growth, the private investment, most of it is private, is also beginning to look up. And this is what I would pin my hopes on for a medium-term growth path, which is higher than that slowdown that we were experiencing pre-pandemic. The third one, which worries me, the third engine, is really net exports. We are all very happy about the fact that exports have been growing very fast, and we should be. But the trouble is that imports are also growing very fast and on a much larger base. So, if your exports have grown up by 35%, let's say, and your imports have grown by 29%, we think that's great. But if you look at the absolute numbers, the 29% growth of a large import base is larger in level terms compared to a 35% growth on a much smaller base. So, in other words, what I'm saying is that the balance of payments remains pressure, the current account balance of payments. And of course, portfolio money has been going out, as you know, for quite some time. So the external sector remains, I would say, a very weak spot as far as the economy is concerned. So consumption remains weak, as you pointed out, but among the independent drivers of public expenditure, investment cycle, and the external sector, it is the investment part which I think I would pin my hopes on. Public expenditure will depend very much on how they perform on the revenue side, and the exports, as I've just explained, in the external sector remains a very major risk.
So one worry that that has been shared by many people is that if your private consumption demand remains slightly weak, and what we've seen is that if you look at the per capita GDP and per capita private final consumption expenditure, those are still below the pre-COVID levels. So which perhaps shows that there are some sections which have obviously gone beyond well past pre-COVID level, but there are many who are still behind it. And so maybe the recovery is not as broad-based. Now, what I wonder, what you said, what will come first? Would the private consumption demand happen first, or would the growth happen first? And within growth also, government spending more is obviously is a government's decision. It can perhaps borrow more to make more capital expenditure. But private sector, how long? First of all, we do not know for sure how much is the private sector involvement in the fixed capital going up, and how long do you think private sector will sustain if the private consumption doesn't really remain attractive?
Yeah, as I said, private consumption will follow what happens to income growth with a lag. So if for other reasons we are able to keep income growing at a decent rate of 7% or so, the private consumption expenditure, which has been lagging behind, will catch up. It is the largest component, which is a big worry. But to me, it's not an independent driver. I think it's just an analytical position I maintain, that if income is rising, eventually with a time lag, consumption will follow. So I would worry more about the what we do on the really autonomous drivers, what happens there, namely the investment cycle, the government expenditure, and the external sector. These is what I would worry about. But just to fill out a little bit on what you said, the impact, as has often been said, it's a sort of K-shaped recovery. The impact, the negative impact, has not been uniform, across different expenditure classes. At the upper end, rich people actually done very well. The stock market was booming, and so on. But it's the lower expenditure classes who are employed mostly in the informal sector, which really got buried with multiple shocks. First, you had demonetization, then you had the flawed rollout of GST, and then to cap it all, you got this terrible, the COVID-19 pandemic. So it's not like a putting your tap on and off. I mean, once an enterprise dies, it dies. It's not as after that you start giving more credit and the enterprise just comes back alive. So there's how should I say, it's a irreversible kind of situation as far as individual enterprise is concerned. But of course, new enterprises will come up and so on. But all that takes time. So I would expect that the private consumption will follow a growth in income, but as I keep saying, with some time lag, because of all these effects. Unemployment rate is still remains very high. The CMI data, which is the only one we have of very up-to-date information, shows that, and this is open unemployment, around 7 to 8%, which is very high. In our country, as you know, there's a lot of disguised unemployment. So the real unemployment rate is much higher than that.
So two questions leading from here. One is, what do you suspect? Because time is of such crucial essence here, because things will take time to recover. And we are seeing global environment, be it the uncertainty due to geopolitics, Russia's invasion of Ukraine and the ramifications it has had on crude oil or other commodities becoming costlier, fertilizers in particular, to crude oil itself, when it goes up, sort of upsetting the apple cart, as it were, for our growth, because we are such huge importers, to monetary tightening. So, in terms of the growth outlook and the importance of time that you mentioned, that it'll come back with a lag, but then we are entering a era or a phase which perhaps will last possibly a year or two. I don't know. You can clarify in terms of monetary tightening and stuff. So where do you see growth panning out from here? And what are sort of the threats in particular? With 2, 3 main threats that you think?
Something we've not so far talked about, but which I think is now a very major risk, at least in the short term, is inflation. If you look at the numbers that came out yesterday, the difference between the nominal increase in GDP and the real increase, the GDP deflator, which is in some ways the most appropriate broad-based indicator of inflation, is close to 11%. If you look at the wholesale price index, that has now been in double digit for quite some time, sometimes going up as much as 13% and so on. On top of that, you look at just retail inflation. Even that is, over 7% now. And this is way above the RBI's target band. So it is quite appropriate. I think they left it too late, but I'm very glad to see that they're now very focused on trying to contain liquidity, raise rates, and so on. But that is a big risk, obviously. The other risk is the external sector on which we don't have any control. Of course, I have a feeling that these sanctions which the Western countries have tried to impose on Russia is not really working. Because China has not, agreed to that. India is finding ways around that, possibly going back to the rupee-ruble arrangement and so on. Even within the NATO alliance, I mean, they made allowance for a country like Hungary, for instance, to continue to import oil from Russia and so forth. So these sanctions remain very leaky at the moment, it seems to me. So even if the Ukraine war continues, and it's having actually, the sanctions actually having a more adverse effect on the Western economy, the NATO countries and so on, because of the much higher cost in fuel prices that they are having to bear, etc. So that can continue despite the fact that the sanctions are porous, and there's a lot of leakage. If this war situation prevails, the Ukraine war, I think this is a big threat to the global economy and therefore to us also. Everything is, related to that. I'm glad to see that China has withdrawn the very strong 100% lockdown that they had introduced, but it's taken a shock. The Chinese economy has taken a shock because they also will take a little time to recover. So the external sector remains, I would say, a big risk point. I mean, you were asking what are the risks. The other, on a shorter term thing, is inflation within the country. Though I feel that this, when the government gets focused on something, by government, I mean both RBI as well as the finance ministry and so on, they seem to be quite frightened now, frankly, by the inflation numbers, and therefore they're very focused on trying to come to grips with that. And that's correct. I think, if you're growing at 6% plus, around 7% plus minus, one shouldn't worry too much about the growth immediately. You should get the. I think they will succeed. But whether this 7% plus growth can be sustained over the medium term or not depends very much, I think, medium term, over the next couple of years, this year, next year, and so on when this, the whole Ukraine situation becomes more benign.
Professor Mundle, if you could now focus on the policy response. You've told us about the challenges that are there, inflation being one big domestic challenge, and then there is the external sector. Now, on the policy response, one thing we heard when the COVID pandemic had happened and in the recovery phase also, was that the government has sort of taken a back seat. One criticism was that the policy response has been more led by the monetary policy or the RBI, and that even the government's response is largely in terms of giving credit guarantees instead of putting as much money directly in the hands of the people. And critics argue that that is what is showing up in poor or lower levels of consumption in terms of the average consumption that we are seeing. Now, given the challenges ahead of us, inflation being one crucial one, again in the policy response, it was RBI first which sort of reacted to inflation, and the government then followed up with a cut in taxes, which was perhaps needed because a lot of inflation was coming through that route. So, what do you think is the policy response now required, given the state of the economy as of now, and what is the type of policy response we need? Whether it should come from government, who should lead it, and in what format? Even the government spending, if at all, then in what format?
Okay. Let me spend a couple of minutes to comment on the discourse that has been there about what the government did or did not do, and the RBI did during the height of the COVID period. It is certainly true that, and that's what the debate entirely got into that, as you mentioned, that instead of giving much in terms of additional spending, they were, giving these credit guarantees and that kind of thing. But if you look at the totality of the picture, and I mentioned this in our earlier discussion, while they did not increase spending, they also didn't cut spending. Whereas the government's income, namely the revenue, took a big dive. So if you look at the difference between the two, namely the deficit, there was a huge increase in the deficit. So in a macro sense, this debate about they were, not spending more, but, giving guarantees, in a sense, I think took the debate off at a tangent. Factually, that was correct. But from a macroeconomic policy point of view, the government did, have a huge increase in the deficit, which is the main instrument that the government has. And to deal with that, it really doesn't control revenue. The thing it controls is expenditure. So when the revenue was going down, it could either bring down the expenditure, or it could keep it at that level, or it could raise it even further, and therefore further increase the deficit. It took that course of, if you look at the numbers, the expenditure did not go down below what they had budgeted. But it meant therefore that the deficit went up a lot, and gave a very big push. Having said that, I agree with the general perception that it was the RBI was clearly in the lead in trying to push liquidity and do our version of quantitative easing and so on, and it did a very good job, I thought of that. Now, the situation that has emerged is that meanwhile inflation, which was very low, subdued at that time, has reared its head, and now for almost a year now we've had high inflation. So then you get into this big problem. Should we deal with deflation or should we deal with growth? And I'm one of those who's been saying, writing, saying that we are getting into a very difficult policy situation in terms of high inflation and not negative, but low growth. That's what we mean by stagflation. However, after seeing the latest numbers, I am less worried about, unemployment remains high. It's been high all along. It's not going to change overnight. Whether the growth rate goes up by 1 or 2% or lower. I would certainly focus our policy effort now on the inflation front, to fix inflation so that medium-term growth can be sustained. And there again, the RBI has taken a lead, as you said, and it's I think they should have done this a little earlier, at least 3 months, if not 6 months earlier. They should have started focusing on this because inflation has been rearing its head. But I think the RBI's own narrative was that, this is transitory, it's going to go. By the way, there's a global debate of exactly the same kind, which is being reflected here. Some people are saying, oh, this is transitory and so on. Others were saying, no, this is going to persist. And this lot who was saying that this will persist turned out to be right, globally. And the same has happened here. Inflation has been persisting. And quite correctly, I think, better late than never, the government is, the RBI is certainly focusing on it. But so is the government. It's, the fuel tax cut and so on. Is an appropriate measure because, a lot of this increase in inflation was being driven by, it's not only imported, on top of that, you have high taxes, which are being raised all the time and so on. So, and that will have a direct, how should I say, moderating effect on inflation. What the RBI does also has a very strong, but more that liquidity goes down, so the credit flow goes down, then demand goes down, and all that kind of thing. This will have a much more quick effect. Having said that, again, there is a kind of division of policy responsibility, if I may put it that way, between the RBI or any central bank and the government or finance ministry. In our case, it is formal. The mandate of the RBI is to only focus on one thing, that namely inflation. Unlike, let's say, the Federal Reserve in the US is supposed to focus on both inflation and growth. Ours is only univariable goal for the RBI. It's a different matter that during this pandemic and so on, it did focus on growth, and I think that was appropriate. But right now, it should be completely true to its mandate and focus on inflation, which it is doing. It's bringing down liquidity. It started raising the repo rate. I expect that it will, at least for the next 2 quarters, repo rates will be raised further. There's some debate about how much it should be raised. And the government also, I think, has done what it should have done in terms of cutting back on these taxes and so forth. Beyond that, of course, this will also mean, by the way, that its deficit will go up. And that's probably not a bad thing from the point of view of stimulating demand, which we were talking about earlier. So I think right now the policy focus of both the central bank and the government is exactly where it should be. I don't always say this, but this time I will say that if I had any to do with it, this exactly would be my policy focus.
Right. Right. Now, one last query about a bugbear that we had, again, pre-COVID, which was about NPAs. And we tried different things to solve it. And it had sort of moderated with recapitalization of banks. And the government has done a lot in that regard. But there was a huge worry during COVID times that this will lead to a massive spurt in NPAs again. Given the fact that NPAs was one big reason why we were struggling to grow in the 3 years leading up to the COVID pandemic, and there's been a moratorium, and most of that has not got recognized. How worried are you going forward that NPAs might re-emerge as a challenge, or is that sorted now?
Yeah, that's a very good question. NPAs were a big problem, and it appeared that it was moderating, but it wasn't really moderating. It's just that the RBI was, had advised the banks to, what is known as forbearance. That is, not declaring NPAs and so on. And there was an expectation that when that forbearance was withdrawn, that you would get a big, jump in NPA and so on. And there was some increase in NPA, but if you look at the, every 6 months, the RBI now comes out with its financial stability report, where they actually do stress tests to see what is likely to happen to the NPA ratios and so on under different scenarios. And those have actually been quite comforting in the sense that that the last report I saw said that it's unlikely to go up very much, the NPAs. And the latest actual number that we're getting, apart from the stress tests, show that really there's been a genuine reduction in for most of the banks. Of course, the cleaning up, as usual, has happened more in the private sector, but it's also happened in not all, but in most public sector banks, the NPAs have actually gone down. And to be fair to the public sector banks, some private sector banks also still have high NPAs, but most of them have actually brought down. So yeah, I think the NPA situation overall has improved quite substantially because of particularly the laws that the government passed on bankruptcy laws and so on. There are views the NCLT needs to do some things about it. These are wrinkles. These adjustments happen, but basically the policy structure for maintaining a robust, healthy financial intermediation sector is working.
Okay.
Does that
Now,
answer your question?
Yeah. Last question, and it's partly provocative in the structuring, but there's a genuine kernel of a question also. The 4.1% growth that we've seen in the last quarter of last financial year, and I was talking to somebody else also that in the coming year, when we talk about a 7.5% overall GDP increase, what we are actually talking about is a massive jump in GDP in percentage terms in the first quarter, and then it sort of moderates across the next 3 quarters. And the number again quoted was 4%. So, after maybe a 15% jump in the first quarter, which is currently on, and then you come back to something like 4% or thereabout in the next 3 quarters. And that reminds me of the Hindu rate of growth. So are we in some ways, because of the base effects and stuff, for the large part actually coming back to the Hindu rate of growth? What's your take on that?
Yeah. First of all, on the more technical thing, let me respond. It's quite true. This has happened last year also. I mean, the year that has just finished, because the previous year, the first quarter, the GDP went down by 25%. So you got a big bump up in Q1 of 21-22. And then it progressively came down, and you finally ended up with, your 8.7%. But that 8.7% means, as you just mentioned, that in the last quarter, growth was only 4.1%. So the average over the whole year gave you this 8.7%. We are going to see exactly the similar pattern this year, not the same number, but a similar pattern. Meaning we are going to get a very high growth rate in Q1. Our forecast actually is 14.7% in Q1. And then it will progressively come down. And for the year as a whole, our estimate average is about 7.5%. But as I said, when I compared what we forecast with what actually turns out, our models seem to be slightly on the higher side, not much, just slightly. So that's why I think that we'll be 7% plus minus, could be 6.5%, something there about that is on the growth. So implicit in that already is an answer to your question about the Hindu rate of growth. Actually, the Hindu rate of growth, which one of our very bright and late economists, Raj Krishna, had coined that term for this 3% growth. But we haven't been there now for a long time. If you forget about these two the COVID years, even that earlier period you were talking about slowing down, in 1 year we went down to the Hindu rate of growth, the last year. That is 1920, we were somewhere, I think we were around 3% or something like that GDP. Yeah. But other than that, we generally don't, get there. And you can, of course, redefine the Hindu rate of growth to say 5% as the new normal of Hindu rate of growth. And then you can say, but that's just a joke. No, I don't think we're going to go back to those lower I think the debate really is going to be between whether we'll be in the 5 to 6% range or whether we're going to be in the 7 to 8% range over the medium term.
So there you have it, a fairly detailed understanding of how to make sense of India's GDP data. Where are the pain points for us, and what are our strengths? Where the next challenges are coming from, and what are the kind of policy response that we should be having? I thank a lot, Professor Mundle, for taking your time out so generously and sharing your insights with us. Keep watching the Indian Express Economist, and we'll be back next week. Thank you.